All right, good morning, everyone. Thank you for joining us here today for our June 3rd, 2021 commission meeting. Before we get started, Mr. CEO, is there any announcements or housekeeping items that you'd like to get out of the way before we get started?
Mr. Chairman, just to make sure, maybe we'll just have a quick roll call, or just everybody, and let us just say if you're on the call from the commissioner standpoint, because I want to make sure that we have a quorum and that we haven't jumped the gun and don't have somebody who's on yet. So if we could just go, I know we obviously have Mr. Hancock here. Ron, we have you, correct? It's Ron Wilder, I believe. We have
Peggy Boykin, Miss Peggy Boykin, are you with us this morning?
She is.
Yes, I'm here.
Morning, Peggy.
Morning.
Mr. Bill Condon, are you with us? Mr. Bill Condon, going once, twice. We'll come back around. Ed, do we have you with us here this morning? We'll come back around and check on you, Ed. Alan, are you with us?
I'm here.
Good morning, Alan.
Morning.
Rebecca, are you with us this morning?
Yeah, I sure am. How are you this morning?
I'm doing very well, thank you. Good morning and good morning. All right, Rebecca, let's see. All right, Reynolds, are you with us? Reynolds going once. Reynolds going twice. All right, let's go back to Mr. Condon. Bill, are you with us this morning?
Says he hadn't joined, and then Ed we heard, but he was reverberating everywhere.
Ed's on, right?
Ed's on.
Ed, we're counting you as being on, sir. I believe we have what constitutes a quorum. Is that correct, Mr. CEO?
Yeah. Well, and we can, before we get anything substantive, we can always pause to catch up and try to.
We might take a short pause in a little bit and see if Mr. Condon and Mr. Williams have been able to join. Maybe they're having some technical issues, as we all tend to in this time. Anything else before we get started, Mr. CEO?
No, sir.
This is Reynolds. I've been on a few minutes.
All right, Reynolds, thank you. Very good to have you. Good morning.
And this is Bill Condon. I'm on now.
Yeah.
Good morning, Bill.
Okay.
Good morning, everybody.
All right.
Supposed to adopt the agenda.
As is.
Mhm.
Okay. All right. So first thing on the agenda this morning is we've been called to order, and I'd like to get a motion to adopt the agenda that as it has been proposed. May I have a motion for that, please?
So moved.
I have a motion. May I have a second? I have a second. All in favor of adopting the agenda, please signify by saying yes.
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 Anyone opposed, please say no. All right, we have an agenda this morning. Next up is the approval of the April 2021 minutes. I hope you've all had a chance to go through those. These were hopefully pretty brief. I went through them and didn't find any. If there's no discussion, may I have a motion to approve April 2021 meeting minutes, please?
So moved.
I have a motion. May I have a second, please?
Second.
All in favor of approving the April 2021 meeting minutes, please signify by saying yes.
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 Anyone
Yes.
opposed, please say no. All right, we have approved minutes from the April 2021 meeting. Next, I'm going to turn it over to Mr. Michael Hitchcock for the chair's report. I have nothing for the commission this morning. I'm sorry, getting ahead of myself a little bit. And as such, moving on to the next item, I'm going to turn it over to the CEO, Mr. Michael Hitchcock, for the CEO's report. Mr. Hitchcock.
Thank you, Mr. Chairman. By one of the agenda items for the strategic calendar that falls under my report for this meeting is a legislative update. Currently, the General Assembly is now in extended session. They've completed their regular session. There are a couple of items still open and remaining for them to deal with, most notably the budget and Santee Cooper. As far as our agency budget goes, our budget request was approved in both the House and the Senate in the version that we requested. So there should not be really any open items in the budget for as far as our agency goes. We were, I believe it was yesterday, the House Ways and Means Committee is the House is working on their final amendment to the budget. And the House Ways and Means Committee met yesterday, and there was a proviso of interest that was adopted. And Peggy can certainly jump in if I misstate anything or fail to completely convey the substance of the proviso. But the way that I read it is basically and it was proposed by Representative Kirkman Finley. And the way that I read it is that it would require PIBA to engage the services of a third party to examine a number of things, including our returns against the S&P 500 and I believe the Barclays aggregate, but in the spirit of making a determination. What I gather as hold on one second, get a little bit of feedback. Okay, as to whether or not the buying members of the retirement system out of the system would be feasible. I'm not necessarily aware of the genesis of the proviso. Obviously, it's something that we're tracking, and I know that PIBA is tracking as well. So we'll see how far that progresses through the process. But that was brought to our attention yesterday. I just wanted to make sure that, in the spirit of providing the update that I did that as well. So, Peggy, is there anything to that you'd want to add?
No, I did have a conversation with Kirkman Finley a couple of months ago, and he seems to be under the impression that if you offer to buy employees out of the system, that improves the funded status. That has lots of legal ramifications. I've asked our attorneys to take a look at it. When we had a conversation, he seemed to be interested in offering them just their account balance and not the accrued value of their benefit, which would be impermissible under ERISA. But I have our attorneys just looking at it to see, what our restrictions are, just so that we can give him a better understanding of what's feasible.
Okay. Thank you, Peggy. Anybody have any questions for either Peggy or I about that?
I have just one. I know in general our stuff conforms with ERISA, but this plan isn't subject to ERISA, correct, Peggy?
That's correct. We generally try to conform to ERISA, but it's not subject to ERISA.
So will that influence that legal determination, you think?
I think we should just leave it to the attorneys. It does influence it somewhat, but then there's also, you have to look at the perception of enticing people to liquidate their retirement. I believe that some of that may also impact whether it's an in-service distribution. Right now, if you terminate, you can take your money out in a refund, but if you're still employed, it's not so much can you give someone less than the accrued value of their benefit, which is impermissible under ERISA, but it's also can they get anything while they're still working? Is that in-service distribution disallowed under our tax qualification rules? So there are lots of different issues at play here, and I feel like we need to get a more thorough legal analysis if this does move forward.
Okay.
Just one final question on that. That all falls on your side of the house, though, doesn't it, Peggy? I mean, that doesn't really influence the commission per se, unless it becomes a dollar figure, correct?
I think where it would influence the commission, it's not something that you would actively have to do as far as handling those distributions. Where it would influence the commission is if there was a significant cash outflow of the system, how that would affect your asset allocation and how that would affect liquidity, because at the end of the day, you still have to pay the retirement benefits that are paid out every year. And if a substantial portion of the fund were distributed in liquidated benefits to employees who are active, I would imagine that that would have a significant impact on, you know, your cash flow projections and how you manage that liquidity.
Yeah. Yeah, Alan, also, you know, the kind of the way that it's set up too, and the reason that it obviously, you know, I think it's something that both Peggy and I have to be mindful of, that we're in communication and working together on, is that part of this proviso requires an examination of our returns against benchmarks that were not necessarily the benchmark. You know, the performance against the S&P 500 and the performance, you know, it mentions that and the Barclays Ag specifically. Obviously, you know, the General Assembly has instructed us to target a certain assumed rate of return, which, you know, is going to vary widely at times over discrete periods of time versus the performance of those two things. So, you know, I think we just got to make sure that we're ready and available, that if that's called into question, that we're providing the necessary information and placing that into the right, or framing that in the right context for folks. So, you know, that's why I wanted to make sure that it was on your radar. Okay. If there's no further questions on that, I'll move on to the next agenda item. And I believe that most everyone is aware that when we did back in the beginning of 2020, when we did the major major amendments to the SIOP, and we adopted the more simplified portfolio, that one of the things that we did was that we allowed in the policy portfolio, we allowed the weight to private equity to continue to float based on the actual amount of exposure that we had to private equity. And the reason that we did that was when we were making those changes, we had just completed a secondary sale in the private equity portfolio. We were down to, I believe, 6.2% weight to private equity. Ultimately, the goal was to achieve and maintain a target weight of 9%. But we did not want to necessarily put ourselves in a position of having to allocate, primarily for the purpose of getting to target weight and being able to make sure that we were allocating responsibly. And then with the understanding and the thought that once we were at 9%, the actual weight to private equity was 9%, and we thought that we would be able to maintain that, that we would amend the SIOP to take that ability for the private equity weight in the policy portfolio to float off. We believe we're at that point. So we are asking for the commission to, amongst the other amendments that were previously adopted to the AIP SIOP this year, that we, as part of that too, that as of July 1st, that ability to float for that weight to private equity would be taken away, and that we would have a fixed target weight of 9% for the policy portfolio. I believe that will make it substantially easier on our reporting team. But, we think that we're at the point where we can maintain that, so there's no reason for us to continue to allow that to float. Certainly willing to answer any questions about that.
Any questions to Mr. Hitchcock about this change to the annual investment plan and statement of investment objectives and policies? Hearing none, I'm going to ask Mr. Hitchcock to read the motion for us to consider.
Thank you. The motion would be to adopt the recommendation of the CEO and amend the consolidated annual investment plan and statement of investment objectives and policies for fiscal year 2021-22 to establish a fixed target weight of 9% for the private equity allocation effective July 1, 2021, and authorize staff to make any technical revisions or formatting edits consistent with the action taken by the commission.
All in favor of this, please signify by saying yes.
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 Anyone opposed, please say no. Any further discussion? I believe the motion carries.
Mr. Chairman.
Next up.
Thank you, Mr. Chairman. The final item in my report is one that I'm asking for the commission to do for me. I think everybody's aware, I'm still a member of the South Carolina National Guard. I am slated to go to Egypt from August the 29th until September the 14th to participate in a joint exercise. Our commission meeting is scheduled to fall on September the 9th. I am simply asking that the commission move that date back to September the 23rd to allow me to be present. And that's the substance of that.
All right, my fellow commissioners, those of you that are able, please check your calendars. I personally do not have a problem with moving this to the September 23rd date. Hopefully you have your calendars in front of you and are able to be able to answer this. Mr. Hitchcock, would you read the motion for this for us, please?
Yes, sir. The motion would be to amend the commission meeting schedule to move the September 2021 commission meeting to September 23rd, 2021.
All in favor of this motion, please signify by saying yes.
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 Anyone opposed, please say no.
Mr. Chairman, this is Bill. Do we need a first and a second?
Well, why don't we back up just a second as a point of order, Mr. Condon? Why don't I call for a motion then?
I'll make the motion.
Then may I have a second?
I'll second it.
Have a motion and a second. Now, all in favor, please signify by saying yes.
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 Yes. Yes.
Anyone opposed, please say no. The motion carries, and so we are now rescheduled to meet September 23rd, 2021. Mr. Hitchcock, I'm assuming that you will pass the word down the line.
Yes, sir.
And get the staff to that.
Yes, sir. That will be taken care of. Thank you, and I appreciate the commission's consideration on that matter, and that completes my report, Mr. Chairman.
All right, with your report complete, I'd like to now turn it over to Mr. Berg, and we will have a report from our Chief Investment Officer.
Thank you, Mr. Chairman. I do want to begin by reflecting for a moment on where we were a year ago at the end of March. If you'll recall, there was a great deal of uncertainty surrounding the pandemic. Markets had been beaten up very badly in response to the world essentially shutting down. Our returns at that point in time were disheartening, but thankfully we were in a very strong liquidity position and didn't ultimately need to reduce any of our market exposures. Since then, thanks very much to a strong market recovery, our portfolio has earned more than $9 billion. As we've discussed with some of you more recently, though, the magnitude of this recovery, while it's absolutely great to see, reminds us that the road ahead still has a number of challenges. So against this backdrop, in recent months, we have been trimming back some exposures, which I'll review with you in a few moments. And despite the fact that this 12-month stretch afforded us a really unique opportunity to generate a tremendous magnitude of return and in fact excess return, our focus remains on improving the consistency of our excess returns on a go-forward basis. So with that said, I'm very pleased to share with you what was another very strong quarter for our portfolio. Portfolio earned over 4% during the quarter and outperformed our policy benchmark by 81 basis points. So this takes us for the fiscal year through March to 20.59%, which is 190 basis points better than our benchmark. During the current fiscal year, we have paid out $461 million in net benefit payments. And this is an increase over where that number stood a year ago of about $124 million. So here we can see our value bridge for the whole fiscal year. So this is 9 months. We began just shy of $31 billion. We have seen, the system has seen over $3.2 billion of requisitions, offset by almost $2.7 billion of deposits. And we did once again this year receive the $110 million legislative inflow. And the investment returns for the 9 months have totaled north of $6 billion. So here I want you to notice that 4 of our 5 main asset classes outperformed again this quarter. These 4 asset classes represent 91% of the portfolio. For the fiscal year, 3 of the 5 main asset classes are outperforming, representing about 83% of the portfolio. And also toward the bottom of the page, Portable Alpha has had a bit of a rough year last year, but has rebounded very strongly for us this year. Purpose of this page is for me to attest that the portfolio exposures have remained fully compliant within the ranges specified in the SIOP. So let me move now to our performance analysis. You can see here at the top of the page that returns during the quarter were ahead of both the policy benchmark and the reference portfolio. In the yellow boxes, we see value from both diversification and portfolio structure in the quarter, but a modestly negative impact from manager selection, and I will get into that in just a moment. I do also think it's worth noting that the reference portfolio, which is that 70-30 passive global stock and US core bond portfolio, was up 38% for the past year. I think this has only happened one other time since the mid-80s, and this time it was simply a function of global equities being up 57% during this time. Now let me offer you the bottom line up front. Our outperformance is still a function essentially of being positioned a bit more aggressively than our benchmark. Specifically, we are underweight core bonds and overweight public equity and listed credit. Our Portable Alpha program has just knocked the doors off it this year. And within our real assets portfolio, we do have listed real assets, and that takes the form of listed infrastructure and REITs. And those performed poorly last year against the private real estate benchmark, but have had kind of the return to the mean this year, so they've performed very well. A key area of underperformance versus our benchmark is our private equity portfolio. We will dig into that a bit later on. And the presence of listed real assets has been a positive. Our managers have essentially performed in line with the beta. So let's dig into the quarterly attribution. We'll start with our portfolio structure decisions. This is pretty simple, and it's a continuation of the same theme we've talked about for the last several quarters. At a high level, it's been very productive to be overweight equities, overweight credit, and underweight bonds. As a reminder, the decision to use portable alpha implementation, because it is not a part of the policy benchmark, is picked up here. And what this number of 40 basis points for the quarter tells us is that the broad universe of conservative hedge funds outperformed a cash rate, which is the thing that makes portable alpha work. Within our real assets portfolio, I alluded to holding REITs and listed infrastructure. In recent months, we have been reducing both of these because of the strong recent performance. We view these as essentially converging to fair value. So we have been modifying the portfolio accordingly. Here we are looking at the attribution data for manager selection. What jumps off the page is this is largely a good story with one exception. Most of the managers outperformed benchmarks with the exception of private equity. As we have continued to receive private equity statements after the date that BNY Mellon cuts off the ability to incorporate those in our March returns, it does appear as though what we're seeing here is overstating the difference between our portfolio and the broader universe. But to be clear, regardless of the exact magnitude of the shortfall, there is a shortfall. And we continue to execute our plan to turn that ship around, but that's going to take some time. This is an opportunity for me to say the same thing that I've said for the last 3 quarters, so I think I will bypass this and jump straight into the plan exposures and how they've been changing recently. I alluded to we remain overweight to equities and more materially overweight to private credit. These overweights come at the expense of bonds and real assets. In terms of how this has changed since our last update, at the end of the quarter, you can see we reduced our public equity exposure by quite a bit. Half of that exposure, though, was replaced by an increase to our private equity allocation. And what you see as an increase to bonds here, I will show you in a moment, is simply building cash in advance of an upcoming real estate funding that will get us closer to the target exposure to real assets. This table has a lot of detail that I'm not going to dive into, but I will give you the conclusions that I take from it. And there are 2 of them. First, we're slightly overweight to public equity, but that is in the amount of 60 basis points. And then secondly, our overweight is spread out geographically, but focused in larger cap equities. In the future, I can pledge today that we're going to figure out a more efficient way to show you this. This table is looking in our bonds portfolio. It also tells us 2 things. First, we're continuing to walk down our emerging market debt exposure. Spreads have compressed to levels we don't find terribly compelling, so we are continuing to reduce there. Secondly, I feel very, very good about our liquidity because in the event of a pullback in equity or if we see a hiccup in the credit markets, we'll have the ability to switch to the front foot in order to take advantage of those. And let me finish here on our risk metrics. As a reminder, what we are looking at here is driven by 2 years of daily data for each of these portfolios. So this includes the extreme decline and almost as extreme recovery of last year. All of these, as a result of including that, are above where we are accustomed to seeing them and are likely to remain above where we are accustomed to seeing them for quite some time. And I can also share with you that there is very little change in what we see here from the prior quarter. So let me just pause there and see if there are any questions on anything that I've just stated.
Questions for Mr. Berg?
This is Ron. Jeff,
Sir.
at this point in the transition to the new asset allocation, are we pretty much completely transformed into the new allocation at this point?
Yes, sir. The areas where that we look different are, if you'd like to think of it this way, kind of residual exposures from the old way. But as I'm showing you here, what used to be a combined 8% to credit is now 2.4%. So we're a lot closer to looking like the new benchmarks than we look like the old benchmarks, if that makes sense. And but these are exposures that we have intentionally, in essence, because of the interruption to the world last year. We just felt that we wanted to slow the move out of credit into core bonds, because A, there was no yield in core bonds, and B, there was a reasonably attractive spread to be had. So these are exposures that have been coming down as those spreads have gotten compressed and are a lot less compelling today. So this is very close to how I think of as the kind of steady state portfolio, with the exception of being a little bit overweight to credit.
Yes, and just to follow up, I just wanted to say that I believe, the early results and the new way of doing the performance analysis against a reference portfolio, I think this really helps us understand what's going on, and I'm really glad to see that.
Thank you. Appreciate that feedback.
Any more questions for Mr. Berg? Hearing none, we're going to move along to the delegated investment report, where we will stay with Mr. Berg.
I have the hot hand. This won't take long. Between the last meeting and this meeting, we have closed 3 investments. Those are shown here, and this is probably the shortest list we've had for a while, but it's certainly investments that we're very pleased to have in the portfolio. So happy to answer any questions, or if they're difficult questions, redirect them to other people.
Okay, hearing none. Moving on to our next item, we're going to talk about committee reports. I'd like to recognize the chair of the Human Resources and Compensation Committee.
Wait, let's do audit. I think we have a report from the audit committee first.
We do have a report from the Audit and Enterprise Risk Management Committee. I'd like to recognize that chair first. Rebecca, I believe you're the chair of that committee. Could you give your report, please?
I am, and it has been posted on Watchdocs, and so I will just refer to that, and if there are any questions, I'm happy to try to answer it, or as Jeff said, defer hard questions to someone else.
Very good. That published report is available for anyone to inspect it. Next, we'll move to the Human Resources and Compensation Committee chair, and that is
Dr. Wilder.
Dr. Wilder.
Thank you. I'm pleased to report that the committee met on May 7th, and that in addition to the regular oversight and administrative business of the committee, the main item facing us was a briefing by Mike and Jeff regarding the proposed variable compensation plan. And after hearing and discussing the proposed plan, the committee approved the adoption of the plan. And so in connection with that, there is a motion. Mike, will you read the motion for us?
Yes, sir. And this would come by way of a recommendation. And Mr. Chair of the committee, this would just get this on to the table for obviously for the commission to discuss, because this is ultimately the commission would have to adopt this. And so just so everybody is aware of how we would look to proceed. And I think we've given everybody an indication of this. We'll talk about I'll read the motion again, which gets it in front of the committee, or actually it's a recommendation. The thought would be that we would then have I'll set up a presentation by Jeff, which will walk through the broad parameters of the program. We will then, in executive session, have conversation and some specific examples that we will talk about in regards to how it would impact the investments, some of the investment staff. Whenever we come out of it, the commission comes out of executive session, then that question of whether or not to adopt, or however the commission would like to proceed in regards to that, would be pending. So just wanted to make sure that I set that up the right way, because there's to avoid any confusion. So, but the recommendation, which comes in essence in the form of a motion from the HRCC, would be to adopt the recommendation of the CEO and CIO to amend Section 5 of the Commission's compensation policy in accordance with the proposed changes presented to and approved by HRCC at that May 7th meeting. And the proposed policy language you all received as attachment 1 to the motions document. I will, for the committee, for the commission's, just to let everyone know, we met with some of the commissioners. We've got some great feedback on the policy language. So we will, ultimately the policy language that we will show you will be an amended version of what was posted. But we'll go through how that's different when we get to that point. But Mr. Chairman, I believe that gets the item in front of us. At this point, I think it would be we could proceed to the presentation if everyone's in agreement.
Well, I don't think that there is a need for a motion and a second. I believe it's just
right.
A vote from the commission. So
right, and which would be just pending after we come out of executive session.
Pending the discussion that would take place in executive session, because we will be using specific employee examples and so forth.
Right.
So all in favor of this motion, please signify by, I'm sorry.
No, we don't do that. No, we wait.
Oh,
yeah. We don't. We're gonna have the presentation in open session, then in closed, and then when we come out of closed, the question will just be pending.
Right, so in that case, I believe then the next item here is to move to executive session.
No, we're gonna do an open session piece first.
Yeah. Okay. Thank you very much.
Yes. Okay. And just wanted to take a little bit of time before we actually get into Jeff's presentation, and hopefully I will not commit my usual sins of the past of saying everything that Jeff's going to say before he says it. But I wanted to make sure that we framed the thought process behind this proposal in the right way. One of the things that Jeff and I and Brittany Story, who's our director of Human Resources, have been working on and thinking about over the past 6 months or so is how we could design a system or a compensation plan that we feel better aligns compensation. And this plan will focus on the investment team, but how we can better align and encourage through compensation superior investment performance. And not only superior investment performance, but also encourage the type of behaviors that we believe will ultimately lead to portfolios that yield that superior investment performance. And what we wanted to do is make sure that we were focusing on the individual and how we encourage individuals. Not necessarily a compensation plan where, in essence, a rising tide floats all boats. We wanted to focus on individuals in a way that we could tailor a plan that would encourage them to manage their portfolios in a way that would exceed the benchmarks that we've set for those portfolios. Obviously, in thinking about this and how we were going to set it up, very mindful of the types of incentive plans that we've had in the past, the PIC plan, and mindful of the impact or that large increases or bonuses, the perception that can have from the public's perspective. Also, and the fact that we wanted to ensure that we were designing this in a way that encouraged consistent long-term performance, not necessarily 1 year's performance, not rewarding 1 year's performance at a time. So we're rooting the investment performance piece of this in trailing 3-year returns rather than in 1 year returns. Also mindful of the fact that if you have a bonus structure and you pay somebody a bonus, they can just simply walk away. And that's not what we wanted to encourage. We wanted to encourage retention. So, so you will see that the amounts, the salary adjustments, both that this provides, that this compensation system provides, will be paid out over the course of 3 years. And you would, in order to collect the amount, you not only have to be present and remain a member of the staff, but you also have to continue to perform. We also felt that if there was going to be an upside to this compensation plan, then there should also be a downside. So you will see that reflected in the details of the plan, and that the best way to approach this was how do we adjust folks' salaries, and how do we better align that salary structure in a way that will encourage the type of investment results that we're looking for. So this is a completely different way of approaching this than we've done in the past. We've tried to be very mindful of where we've been, really trying to set a course to how we better manage the portfolio in the future. We believe that this plan does this, and we have confidence that it will be not only a great incentive tool, but also a great retention tool for us to encourage the type of performance and behavior that we're looking for. So Jeff is going to run through the 2 remaining slides in his presentation. But no, Jeff's going to run through like I said, the high level mechanics of how this will work. And then when we move into executive session, we'll give you some more specific examples on how it can impact particular individuals. So, Jeff.
All right. I will apologize in advance if I say the same thing a few times for what Mike said, but what we've really been working on is a way that we can more thoughtfully use compensation as a management tool. What I mean by that is if we're able to do this in a thoughtful way, we believe we can create really effective alignment with our big picture organizational goals. And to do this effectively, though, we think that a plan should have a lot of the elements that you see here. As Mike alluded to, we think an employee's pay should be tied to the extent we can to the impact that that employee has on portfolio returns. In several parts of the portfolio, what we're going to want to see is consistent excess returns, so that in these areas we will incorporate a consistency measure. We will include behavioral factors, and we'll spend a little more time on this in a minute, but the purpose of these behavioral factors is to reinforce the notion that if we're doing these things today, Mike and I believe that we're doing the things that improve future returns, and we're reducing the risk of the kind of mistakes that can impair returns in different parts of the portfolio in the future. So we think there's an important risk management component to this. We also think it makes a great deal of sense to pay out, as Mike alluded to, an amount that is earned over a series of years in order to have this program help reinforce, employee retention. And finally, when we get to see the examples, we want the metrics to be easy to measure, because we think that just having that directness is appropriate. So how does this work? Investment team employees would have 10% of their salary at risk in order to have the potential to earn 25% upside. Any amount is paid out as salary, so that's what we mean when we talk about this being paid out over years. It's paid out in the form of a change to their salary that endures for 3 years. If an employee has poor outcomes, the answer is yes, it would lead to a reduction in pay. If an employee leaves before receiving an amount that has been earned that was going to be paid out, that amount is just forfeit. And the plan the way we think about this is the plan will use annual measurement periods that consider both the individual's 3-year trailing returns against an appropriate benchmark for that person, as well as those behavioral factors that we believe improve the probability of stronger returns in the future. And when an individual is fully phased into the program, their investment performance will account for 80% of their variable compensation outcome, and the behavioral elements will account for 20%.
Yeah, just go back 1 second.
Sorry.
Based on that last bullet, and just so the commission's aware, this this presentation was posted before we had some subsequent conversations with commissioners. And you'll see when we do the policy document later on that that last bullet, where the ability to modify for 2.5 up to 1 down has been taken out. So we've agreed that is something that we could remove from this. So I just wanted to make sure that was up front and not causing any confusion.
Okay.
I have a question. Given the rolling nature of things, is this effectively going to be sort of a 1/3 sort of thing? I didn't think about this when we discussed it the other day, but sort of lock period, right? Because you kind of have this rolling period effect going through, and it almost seems like this winds up being an annual adjustment, or is it like a 1/3 weighted, right? Sort of, in essence, kind of a 3-period thing leading to a year decision.
Alan, I think it would be it's annual measurements, right? So annual salary, so annual adjustments, but those would be spread out over the course of 3 years. So ultimately, if there's positive effects. So for instance, if you were your trailing 3-year return, it would take having a trailing 3-year return that exceeded the policy benchmark of your asset class and you would have to have that each year for 3 years. So that would be measured yearly. So to get to the 25%, you've got to have 3 years of trailing 3 years in a row. If you start having, you've got a good year, and you'll see an example of this later, but you have a good year, bad year, those positive and negative impacts will net against each other. So if that makes sense, but it's always a trailing 3, but it's measured on an annual basis. But the benefit or the detriment is spread out over 3.
Alan, is that responsive to the question?
Yes, I believe it is.
Okay. So let me move on and offer you an example of how this would be structured for an employee. And the way this works is in this example, we have 7 questions that are emblematic of how we want this to work. These are not soft questions. 6 of the 7 questions are answered with a simple yes or no. And the other question is answered with 1, 2, or 3. We are not asking questions about whether or not somebody is a pleasure to work with or things like that. And this is a pretty direct approach. And I think that's good because it helps people understand how to do things in a way that aligns with our values. But I'll refer you to any one of these questions. There are 2 questions on returns. Is this person having a 3-year impact that has improved returns, by outperforming the benchmark? And if so, how many of those last 3 years have the returns been above the benchmark? And so we're asking, is the performance above a threshold? And then we're asking about whether or not that performance exhibited the pattern that we'd want to encourage. So what we're not trying to have in, this is the persistence model. So this is where we're asking people to, not try to shoot the moon. We're asking them to approach portfolio construction in a way that is going to lead to consistent outperformance. So if we see a portfolio that has underperformed for 2 years and is saved by a big 3rd year, the answer to question 1 is yes. But the answer to question 2 would only be it outperformed 1 out of 3 years, and that's just not consistent with the persistence that we're striving for. So in that case, the award would be kind of modulated down for the returns factor. And then the questions are areas that we think are just really important, and this will come to life. Some of this will come to life when we talk in detail about asset classes later on. Did the employee perform and document diligence evaluation on X number of strategies? These numbers are not specific to any person. Portfolio quality is at least 80% of the asset class portfolio with quality firms, and we're defining that as being well regarded by our consultant or referred to us by an important strategic partner. I don't want to go question by question, but these are yes, no questions, and in structuring it this way, we believe that we can avoid ambiguity that can create issues when judgment comes into it. So these are going to be very much yes, no questions, and we think that's the right way to approach this. Let me talk for a moment about new employees. And by new employees, I mean 2 things. I mean, first, an employee that is new to the organization, but I also want to talk about an employee that is new to an asset class or new to a position. In both situations, the person doesn't have a track record that we can use. So the way we propose to address this is to have a phase-in that during this phase-in relies more heavily on behavioral factors in year 1 and 2, and this you can see in the top set of boxes, before ultimately converging in year 3 to our 80-20 returns to behaviors relationship. But an employee that is new to the organization, and now I'm going to shift to the bottom part of the boxes, would not be fully eligible when they started, but would rather begin at a subdued participation level of 50%. And then for the first full year. Then the second full year, that would rise to 75%. And then in year 3, they would be able to fully participate in the program, and that would occur at the same point in time that they also arrived at the 80-20 returns to behavior factors. So the internal transfer, though, that's a different type of new employee, and it would function in the top box the same way with the emphasis on behavioral factors, but we would not seek to reduce that person's participation, and that's simply because we wouldn't want to penalize somebody for raising their hand and agreeing to change asset classes. So I have just said everything on this page, so I'm just going to bypass that for the moment.
Jeff, this is Bill. I've got a question.
Yes, sir.
Can you go back 2 slides to the behavioral factors?
Yes.
Yes. So just to be clear, these 5 behavioral factors there. They're just examples. Is that right?
Correct.
I mean, some people may have 2 of them. Some people have all 5, or some people may have 7 or 8 different things. Is that right?
So we have envisioned this as focusing on 5 or fewer. So, but what I can tell you is, thinking about this as I have about each person on my team, I can tell you there's not going to be two factors for anyone, and there will not be 8 factors for anyone. So I think that by and large, we're zeroing in on 4 or 5.
Jeff, this is Peggy. Could you also talk a little bit about how you determine the benchmark for each individual?
Sure, that's a great question. And it's an important question because we have to distinguish between an asset class in which somebody has complete control. So our bonds allocation would be an example of an asset class where we could change that portfolio very quickly. So that would just, somebody operating in that asset class would be responsible for, very simply, the performance against our benchmark that is the policy benchmark. In an asset class like private equity, though, as an example, we have investments that were made 10 years before somebody, or actually somebody, we were able to add a very important third person to our private equity team. We have investments that are, I believe, occurred 13 years before that person got here. So the way we envision this for situations where we don't have the control over every line item in a portfolio is to have a composite that relates to the investments that individual was a part of, or the investments, I'll put it slightly differently, that occurred in that asset class while that person was employed with us in that seat, if that makes sense. So for private equity, we're going to have to create composites essentially by vintage year, and we'll be asking the question: is that are the investments that this person was a part of, are those investments outperforming the median private equity fund from that year, and creating a composite that works that way.
Which is Peggy, basically what, like for instance, what private equity would be the vintage Burgess data, which is, we're using Burgess, which is now for private equity, which is a peer benchmark. So the benchmarks would ultimately be the same. It's just we would have to tailor. The only tailoring would be you would just be responsible for the performance in that situation against the asset class benchmark for those investments that you had some influence over. But otherwise, the benchmarks are the same as the asset classes.
Peggy, is that responsive to the question?
Yes, thanks.
Okay, thank you. So there are a few other details that we have here on this page that we think are really important to spend a moment on. The first 2 relate to employees whose responsibilities go beyond just a single asset class. So we want to acknowledge that for these people, we will create a composite that weights their portfolio responsibilities. Secondly, for voting members of the Internal Investment Committee, they will have a component of their variable compensation plan that hinges upon the performance of the total plan versus the policy benchmark, and that is reflecting their responsibilities that go across all asset classes. We also propose a different system for folks that are not directly responsible for making investment decisions. For these individuals, the program would not involve downside, but would also limit the upside to 8%. the performance component for these individuals would be based on the total plan versus policy as a return measure. They would have behavioral components, and it would work like the other plan, but just this is in recognition that these people are not making investment recommendations and therefore shouldn't be tied to this exclusively to any single asset class. And finally, as we have discussed, the CEO would annually review the details of the program with the HRCC. This would include both during planning review in advance of a performance year, as well as an ex post review of the outcomes for individuals. So let me pause there and see if there are any questions.
Well, yeah, this is Bill. I'll ask it now. I had the discussion with Jeff and Mike yesterday, whether the CEO is part of this plan, because Mike certainly does a lot related to investment. So just looking at this slide, I'm thinking he might fit into the first bullet or the third bullet. I thought he was the member of the internal investment committee, but I think they told me yesterday he's not.
Yeah,
So,
Bill,
and maybe we need to discuss that later, but I just wanted to bring up that thought right now, that I think we need to state whether the CEO is or is not a member of this plan.
Yeah, and Bill, just for clarification on the internal investment committee, I appoint the internal investment committee. So Jeff, not Jerry, Jeff is the chair of.
Either way.
Yeah.
Either way.
And then obviously I have, responsibilities in regards to oversight and, the employment status of the CEO. So, and close all investments. But
Yeah, you sign those documents and close them. Yep.
Yep.
So certainly a lot of involvement in the investments.
But, maybe that's, maybe the commission just wants to have some time to discuss that, since I guess it's specific to me, and that might be a matter better for closed, if, not to try to be less than transparent, but might have a little bit better, conversation on that. So.
Yeah, I just thought it was relevant to this slide.
Yeah.
So
Sure.
I would just bring it up now. We can discuss it later.
Makes sense. Yes, sir. Go executive sessions.
If we have no more questions for Mr. Hitchcock or Mr. Berg about this variable compensation plan proposal, I think the next thing on the agenda is for us to move into executive session, whereby we can discuss examples of specific employees with specific criteria and how it would affect them. As such, I'd like to call for a motion to go into executive session.
And Mr. Chairman, if I can read because I think there's a couple other matters that we have too, and just want to make sure that we're.
Well, then let's include all those, if you
Yes,
wouldn't mind reading the motion that's printed here.
Thank you, Mr. Chairman. A motion to proceed into executive session to discuss investment matters of specific private equity and portable alpha investments pursuant to SC Code annotated sections 9-1680 and 9-16320. To discuss personnel matters and compensation pursuant to SC Code annotated sections 30-4-70A1, and to receive legal advice from legal counsel pursuant to SC Code annotated section 30-4-70A2.
May I have a motion for that, please?
So moved, Bill.
May I have a second?
Second.
Second. All in favor of moving into executive session at this point, please signify by saying yes.
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 Anyone opposed, please signify by saying no. We're now in executive session. We've adjourned from executive session. We're now back in open session, and I believe we have some action that we need to take at this point as a result of the discussions that we had in executive session. And I'll ask Mr. Hitchcock to present a motion for that.
Thank you, Mr. Chairman, and this does procedurally, I believe this comes by recommendation, so we don't necessarily need a motion in a second on this one, but the substance of the motion would be to adopt the recommendation of the CEO and the CIO to amend Section 5 of the Commission's compensation policy in accordance with the proposed changes to and approved by the HRCC and Human Resources and Compensation Committee, with a proposed policy amendment being set out in Attachment 1. We have reviewed Attachment 1 with the Commission. There are 2 caveats to Attachment 1, and that there is a desire to include 2 tables of examples. One would be a table example showing the cumulative, how the impact of a stylized example showing how this could impact a person over the course of several years. We do have a table to that effect that we can include in the document, and also a table showing the impact of the phase-in period for a new employee. So with those caveats, that would be the recommendation.
So without the need for a motion and a second, I'll call for a vote on the matter right now. All commissioners in favor of this recommendation, please signify by saying yes.
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 Yes for me. Anyone who's opposed, please signify by saying no. The yeses have it, and this carries. I believe this concludes the business of the day. Mr. Hitchcock, anything else?
Nothing further, Mr.
Mr.
Chairman.
Berg, anything else?
Nothing for me, sir.
Anything from any other of my fellow commissioners? There being none, I'll call for a motion for adjournment.
So moved.
May I have a second, please?
Second.
All in favor of adjourning, please signify by saying yes.
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 I believe the yeses have it. Thank you, everyone.
Thank you.
Please
Thank
be well
you.
and safe.
Thank you, everyone.
Thank
Thank
you.
you.
Bye.